Great, great. I think we're all good. What's the time? 4 minutes over. So I think we usually give folks about 5 minutes or so to pile in. So we'll give people a couple more seconds here, and then we can dive into the first slide. I hope everyone had a great holiday yesterday, and I hope everyone's week is going well. Um, some big announcements going on for Cityfunds. For those of you who are new, we have been up for around 2.5, almost 3 years now. And we've been led by John Green, who's our CEO. Up until this point, John and Sundance have kind of steered this ship, both mortgage backgrounds and real estate. And ending our seed extension, we just onboarded Torstein, the co-founder and previous CEO of a very big real estate investment platform called CrowdStreet. Sundance, you probably know more about CrowdStreet than me. What I know is that they've raised $4.3
Hmm.
billion, I think, total on their platform. So for those real estate junkies on here. It's a marketplace, and they've had a lot of eyeballs on them. They've done some great stuff. So I just want to start this off by announcing some big news about just the growth of the team here, and preface it by saying it's really great to have someone who has been where we plan to go, to come on board and push the wheels on all the exciting stuff we got going on.
Yeah, you hit the nail on the head with the over $4 billion worth of fundings. I think that's really the takeaway there. So Tor has that investor relations and investment platform background that neither John or I have. All right, we've got mortgage background, real estate background, specifically residential real estate, single family homes, which is what we invest in. But Tor brings a separate set of skills regarding raising money and really growing these funds and making sure that we've got the liquidity available to go make all of these really advantageous acquisitions. So
Yeah.
super
Yep.
stoked about it.
Cityfunds here. We are a real estate investment company. Again, thanks for hopping on. For those of you who aren't familiar, through Cityfunds, retail investors like you and I can own home equity in some of the most in-demand parts of the US. So you see here on the picture, we got a Dallas fund, Tampa fund, you see the Miami fund. Those are just three of our 8 markets that I believe we're in. And we'll talk about those in a second here. And I believe we have, I think, another one launching soon. So that will be a total of 9. And we'll dive into what all that means here. So again, real estate investment company. Overall, our goal is for our investors is to make you guys money, to help you grow wealth through an alternative asset that seems very straightforward, but as businesses innovate, there's a bunch of different ways that you can do investing, and specifically real estate investing. And that's a really great draw to our fund. We'll go into really what makes us different, but I think high level, just to keep it very simple, you have a lot of funds that buy properties and they rent them out to get consistent sort of cash flow. You have other properties that might do sort of some debt funds and just some other strategies. I think our strategy has to be one, the most unique and innovative on the market. And as Sundance can go into here in a few slides, I believe it's one of the most profitable in the market. And that's important because with all the noise out there in alternatives, you want to find a fund that sort of has it all. Great liquidity, great performance, accessible. We're tech enabled. You can invest in one of our offerings here in the next 5 minutes. You could be signing up as I'm talking here. It's a great way to do a task and invest into an asset that previously, though straightforward, can be sort of difficult to get into. So, to get us started, our mission is really to make it as simple as possible, but still make it very innovative and very exciting for those of you to, make money and make good money through this. And I do have their long-term wealth for those of you who know real estate. It's not the most liquid asset. There's the stock market where you're looking at your mark to market pretty much daily. We evaluate our properties every single month, and I believe that's in terms of marking, very um liquid, and we update that a lot more than other fund would, quarterly or yearly and stuff like that. So I think it's really great that investors get to track their investments with their app, and kind of show that transparency there. So that's our mission. And where it all spurs from is what we're doing at Cityfunds is we're unlocking the home equity market across the U.S. That equates to around $37 trillion. And how that breaks down is the average homeowner in the U.S. has around 300,000 in their home equity, and that's their house. If you take it very simple, you have a house that's $1 million. A homeowner might have 600,000 in mortgage, and the rest of the 400 is in equity. And it's very challenging to tap into equity without increasing your cost of living or tacking on more debt, changing your debt to equity ratio, paying more monthly over time. And when I say that, I preface a couple strategies for getting equity out, like HELOCs and cash out refinances. So Sundance will go into that. We have another product that complements Cityfunds. It's more on the homeowner side, where we partner with homeowners. We offer them liquidity in exchange for equity in their homes. And that's the equity that we sell in the form of Cityfunds that you guys could tap into. So we have homes all over in these top markets where we partner with homeowners. You might have checked our site and saw the Miami City Fund. You click on it, you see a home in the Miami region. And a homeowner lives in that. It's an owner-occupied home that we partnered with in order to let you, the investor, literally put dollars and invest into that home's equity. Seems very simple, but the underwriting can be complex, and is a very innovative strategy the team has successfully been able to launch and turn over, which is really, really cool. Sundance, I'll go ahead and pass it to you. I think I've spoken so far about a high level of our strategy. Investors, on this call, you can invest to the home equity in these homes across the U.S. And we do that because we partner with homeowners. We provide them with liquidity, and that asset is underwritten. It's called a home equity investment or home equity sharing agreement. This is your side of the house. You underwrite these. Can you go down on kind of these 5 points and talk a little bit more about what a home equity investment is, what a HEI is?
Yeah, absolutely. It is an alternative to a HELOC, or just somebody selling their house to obtain the cash, or refinancing their first lien. So we will contact homeowners primarily through third parties, Deyon. So we have relationships set up with solar companies, pool installation companies, ADU, accessory dwelling unit companies. They will go out and find the homeowners that want to access equity for a home improvement project, and we provide the funding. We do that, excuse me, in a couple of really unique ways. The way that has been most popular currently that we're using moving forward is an option contract. It's a long-term 10-year option contract. We will offer, let's say, in your scenario earlier, Deyon, you had $1 million property. They already owed 600,000 on it. They've got, according to our guidelines, they've got access to maybe another $250,000 worth of equity that we could help them tap into. We're going to limit that to probably, let's say, 100,000. So that's 10% of their overall value. But we don't want to pay retail value as investors, right? So what we do is we leverage that. We option $185,000 worth of their current equity. And what that does is effectively buys the property at a significant discount, or put another way, gives us a lot of downside protection. So we gave somebody $100,000 in cash today, but we reserved $185,000 worth of their equity. Now that $185,000 that we've got the option on, that valuation might go up or down. A lot of people see in the news recently, hey, isn't Austin, stagnant or gone down just a little bit? In some cases, it has short term, but there's never been a full 10-year period of time where real estate has gone down. So our $185,000 might be worth $165,000 right now. But lucky for us, we bought that at a significant discount. We only paid $100,000 for it. So we're still at $185,000 or $165,000, valuation, given that scenario that we just talked about. Now, some people are wondering, like, well, how is this a good deal for homeowners? Why would they be interested in that? And the short answer is because of cash flow. So if somebody wants a solar installation or one of those fancy Tesla batteries that goes on the wall, well, they can do that. One of those Tesla batteries, I mean, you might get an $80,000 solar system with that battery, or maybe even a $100,000 system with that battery installed. There's zero monthly payments for that installation for 10 years. Your equity, if you're a homeowner, is paying the bill for you. They have pre-sold some of their equity that when they sell their house in 10 years, or if they want to refinance, cash out, or do whatever they want to do in 10 years. But now they have zero monthly utility bills and zero monthly bills for their solar that's up on their roof. And so their cash flow is significantly better. And you and I both know, with inflation being an issue currently, cash flow is king. So clients like the fact that there is a cash flow, component to this. They like having zero monthly payments, hence the name Nada. So their monthly payment is Nada. We just want to share in the appreciation over the long term with them. And they may, in fact, they might actually pay a little bit more than if they had a HELOC. It's variable based on how much the house appreciates, but that cash flow makes up the difference for them. So by having that flexibility of not having to make a monthly payment, they can pay off credit card debt or a car loan or something else that's higher interest, or make sure their quality of life is better. So, in a nutshell, we give people cash for their equity, and then we leverage a future higher amount of equity. And hopefully the house appreciates. In all cases, as I said before, there's never been a 10-year period where housing has gone down.
Mhm.
Did I miss anything?
No, but sorry, you said something the other day that I wanted to hit on. You were saying pretty much for every $1.85 of home equity, our investment team is acquiring that for about $1. That's
That,
sort of,
that's correct. Yes.
yeah, which is very significant for
Yeah.
you on call. If you were to say, hey, if I were to go on Zillow and see a home and I want to invest in it one off, put aside all the taxes, the management, everything that you'd hate about owning a property and trying to do an investment on your own. Also, just think about the buy. You see someone on Zillow, your goal is, man, I wonder if I can get that for an extremely good discount. Well, one way we're able to do that is because we're literally partnering in an agreement with the homeowner. So we're able to get these insane rates that put you in the money in day one on your investment. I think that's one of the most beneficial aspects of our fund that I think over time people really need to let that sink in, how that can increase your gains over the long haul. All right, let's move on here. So Traction, our fund officially became SEC qualified about 2 years ago, September 2022. We've been onboarding about 100, maybe more investors a month into our platform, investing in these markets here. We have about 8 now. Sundance, the plan to have one in every single state.
I don't know if we'll go every single state. But yes, we do want to be nationwide, eventually. They're going to come in tranches of 10.
Mhm.
And some of that will come from investor demand. So we hear people are wondering, okay, when is, Jacksonville going to open up? When is Charlotte going to open up? So where we go depends on the feedback that we hear from, the investing audience.
Yep. I'm glad you mentioned that. I oversee investor relations to the fund, so I'm sort of front facing, talking to a lot of you investors. I'll put my number here at the end. If you guys have any questions, you guys can email Sundance or I. Investors are always asking, okay, I come to the fund for the first time. I like the strategy. I like HEIs. I want real estate. I want to own equity in these top markets, but I don't really know which markets to get into. Why would I choose Austin over Dallas or Los Angeles over Tampa? Why did you guys choose these cities in particular? Just how do I really get started? What should I choose? So, Sundance, do you have any advice or, top of mind tips, putting yourself in the investor standpoint? You come to Cityfunds the first time. How should they think about investing into either one or all of these markets from sort of a first time sort of look at the site? How'd they go about that?
Yeah. The nice thing about all of the individual properties is that you have the ability to create your own portfolio. It's it's a fairly low entry point, $500. You could put $500 in Miami, $500 in Tampa, $500 in Austin. If you want to have like create your own portfolio, you're more than welcome to do that. Everything is separate, so you can manufacture that. You can weight Dallas a little heavier. You read an article that said, "Hey, new business is still coming to Dallas." I live in Dallas. I know this area. I think Dallas is probably the best city fund that we have available right now. But if you live in Florida or if you have family in Florida, maybe you happen to know that, hey, Tampa is on the Gulf Coast. They're less likely to get impacted by storms. People are moving from Miami to Tampa. Well, if you know that, then you want to go invest in Tampa. So you can create whatever portfolio weighting that is interesting to you. Now, I always recommend having a little bit of knowledge about the markets that you go and invest in. In fact, we as a company, we only invest where we are familiar with the market. So people always ask, hey, why did you start in Texas? Well, we're based in Texas. We know the markets here. So we want to make sure we made smart acquisitions. As we expand, we get boots on the ground in all of these locations. So now I lived in Phoenix for many years. So we've got contacts in Phoenix. Phoenix will go live here shortly. Now we know what we're investing in at those locations. I recommend you do a little research. We've got some great blog posts on the site as well. You could do some research and say, okay, you know what? I really like Austin, but what do I know about Austin? Go read some blog posts on it. Educate yourself. Do you really think Austin is going to make a turnaround? Is it going to have, a higher growth than Denver in the next 5 to 10 years? I don't have a crystal ball, but you should make that decision, and we give you the opportunity to make that decision, and you can sprinkle a little bit in both to kind of diversify yourself. I really like the diversification that
Mhm.
comes along with this, and eventually a really cool like secondary market or equity arbitrage. All that stuff is on the docket. Maybe a few years down the road, but it's coming.
Yeah, thank you. And I like you sort of went into some of the details of the funds here that might be good to kind of gloss over. So, as Sundance alluded to, these individual markets you can invest into for a minimum of $500. So very accessible to get in for private real estate. I'm sure if you've done your research for private real estate companies, some start at 20,000, some start at $250,000. So you do not need to be accredited, which is the SEC income qualification that you might see across alternatives online to invest in certain private investments. These are Regulation A securities, so you do not need to be accredited to invest in these ones. You don't need to be accredited, and they start at $500. So I think one benefit of our fund, we try to make these funds very accessible for people to get in these and start growing their wealth. What are they targeting? It's a big question. And these markets target anywhere between 14 to about 18 percent IRR annually. And in terms of liquidity, we plan to open a redemption program around mid 2025. So if you get in these, you're able to look ahead to some liquidity for these shares in the near future here, rather than opposed to other funds that where you're kind of sitting on shares for 5 to 10 years. We also plan to open secondary trading for these funds. So if you don't sell them back to our fund, you can sell them to other investors, and all that's coming by next year. So and that's just the growth of our fund. And we'll go into, I think that's the last slide. We'll go into a Q&A here in a bit. But so be thinking of some questions in terms of, you just go on the site. What would you like to know about these funds? I think we hit on minimum and the qualification for those. And while you're thinking of those, you can get onto the site. You can download the Cityfunds by Not app on your cell phone through the app or Apple Store, Google Play Store. You pretty much sign up, connect your bank account. You go through what we call KYC AML, which is just know your customer. You put in your name, email address, all that stuff like that. We compare your ID to make sure that you're a real human. And after that, you're able to invest right there. You can put in your first investment, press invest, and just like you're buying stocks, you can own real estate here within the hour. Our funds range from around $10 a share all the way to our largest fund, which is an accredited offering. It's called the Select Fund at about $112.09. And that fund is a fully diversified portfolio of HEIs across the entire Cityfunds portfolio. So for those who want that diversification, don't know which markets you can choose, you can invest directly in that fund if you qualify and invest in that. Did I miss anything on Get Started? That's probably good. I know we're making updates every single month based off feedback to improve our operations. So, Sundance, is there anything I'm missing here in terms of getting started that might be helpful?
Um, And I would like to say, even though and we anticipate secondary markets, redemption periods, I would still recommend that you be prepared to hold your funds for, roughly 2 years, just to give our team enough time to actually put your money to work, because this is real estate. We want to make sure that we invest it and it's held for a few years, enough time for us to really, extract equity and build up the valuation of the portfolio. Second thing is those accredited offerings. Some of those are really killer. So as Deyon was saying, it's diversified, fully diversified, and sometimes it holds, and not sometimes, it does hold what we call opportunistic outside of those like 8 cities HEIs. So you have one deal from California's in there, one deal in there from Pennsylvania. We got one deal in there from Oklahoma. So we have a few other opportunistic properties that have come our way, and these are no load funds as well. So no upfront fees. So if you put in $100 or $10,000 or whatever it is, that's how much gets deployed. The fees paid for, don't come out of your initial deposits. So it basically, hey, if you do well, we do well. We want to go ahead and build up that portfolio as well. Deyon, I think Phoenix is about to go live if it hasn't. They might get a little bit of a sneak peek, but I saw an email go around that said, "Hey, I think the promotion was up on the website. If it's not up now, it's about to be. So everybody will go there and go refresh."
There you go. Yeah, after this call, if you guys haven't checked out the site yet, cityfunds.com, cityfunds.com. Go on there. I would just browse around, look at our offerings. We have both growth and income funds. So, as we just changed the onboarding of our site. When you log into our site, you should be asked if you're looking for growth or income, and we can better assist you on kind of what your goals are there. And if you have any more questions, again, you can reach out to myself or Sundance, and we can try to figure out what's the best, plan of action for you if you're just getting started in real estate, or if you're experienced selling off some properties and have the cash and you really like what we're doing and say, hey, how should I allocate this capital here? That's what we're here for. We're here to help. So, I think the first step really is going on the site there, taking a browse for yourself. Letting that absorb, and then go ahead and book some time with me on the site. My link's posted, and I think that's the best way you and I can sit down and we can talk about your portfolio. So without further ado, we can we have another slide here. We announced retirement investments with your IRAs. So if those of you in call, if you have a retirement fund, like a 401k or a Roth IRA, traditional IRA, reach out to me. You can book time with me, and we can talk about the best course of action on how to use that IRA into Cityfunds. Very, very straightforward. If you have a self-directed IRA already, reach out. Let us know the amount, which fund you want to go into. We'll send you a subscription agreement, and we can get that taken care of in about a day or so. If you don't have a self-directed IRA and you have a Roth IRA, traditional IRA, sitting in one of your portfolios, say, hey, I want to do a partial IRA, but I don't have the self-directed account. We work with a couple partners that we can pass you to do a partial IRA. Open an account within 5 minutes, and you're able to do a partial IRA, take that cash into those funds, and we have special City Fund links for those partner self-directed firms. So once you make that quick account within 5 to 10 minutes, you can reach out. We'll send you a direct link to the fund you want, and you can make an investment there. So our partners make it very seamless for those who are looking to use their retirement capital. Some of the benefits there, alternative investing, in a tax benefit benefited account over time. It just compounds your gains when you have that kind of deferred benefit protection and potential higher returns because of that. And then more options for your retirement, I'd say, is kind of that bottom one. I think most people, when they have their IRAs, you think there's sort of like a box of options that are, stocks and bonds typically. But just know if you have, retirement capital, through our partners, you can invest in just about anything you want. That's a regulated security for the most part. So I think that allows you to think of all the other things that you can get into, including Cityfunds here. Um, so with that said, I think, let me see, we have more slides, questions here. If you guys have a question or two, you guys maybe browse the site as we were talking, go ahead and send it in the chat here, and Sundance and I will pick it up. I'm kind of sharing my screen, so I can't see. Um,
I don't have anybody in the chat currently, but you did mention income versus growth strategies earlier, and I was hoping you could kind of expand on that just a little bit. What's the difference between income and growth, and what when's it appropriate, just roughly speaking?
Yeah. So income, typically lower risk vehicles that have, more liquidity, constant cash flow, as opposed to growth, which are tend to be a little higher on the risk side. But because you're getting that higher risk, you are expecting a higher reward. So we have two offerings in our accredited pool, and there's broken up by growth and income. And the growth pays out about 8%, 7% APY for the year, paid out quarterly. So very low risk, 7% annually. You're getting paid that out quarterly. Very straightforward for people who are focusing more on that income paid out quarterly. And the growth is for people who, you're not too worried about getting cash up front. Maybe this is an IRA account and you're saying, hey, this is my retirement. I'm not going to use this anytime soon anyway. I don't want cash flow coming in my retirement account, making things complicated. I just want something for my retirement, I can put it in, let it sit for 5, 10 years, 3 to 5 years. You're probably more focused on a growth fund. You're going to get a greater return on average. And also it's going to be a little higher risk. And those are kind of, I think, the way you should approach both options there. And I think in terms of the Reg A, we have the growth. All of our funds are default to standard growth funds. So if you want to do an income fund, we at this time have one offering, and it's for the accredited uh, pool only. But based off feedback, it's been a hit. A lot of people are getting that fund. I think we can explore other options for the Reg A market as well. Just be able to accommodate more
Oh,
folks.
all based on investor demand. All right,
Hmm.
well, I think we started a few minutes late and we went a few minutes long, but all in all, about 30 minutes.
Yeah, yeah. I will go ahead and uh pop in. I took my screen down. So for those uh on call, I'll put here Deyon at cityfunds.com, 972-736-7041. That's my direct line there. So for folks who want to shoot me a text tonight, say hi, and maybe it's going to take you a second to absorb kind of a few things we went over. You can book time directly with me if you just shoot me a text. We can hop on, tomorrow, or we can book time sometime next week. But no obligation. My goal is really just to figure out if this could be for you or is for you. And I can only find that out if you guys take the chance to reach out and try to, have that personal growth and talk about finance and talk about, how you can better yourself there. Then we can try to work something out. And hopefully find something that would be a good fit.
Good stuff. Deanne, it's always nice to be on these webinars with you.
Oh, thanks.
I like talking shop.
Yeah. 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 All right. Well, I hope everyone has a great evening. We'll be around tomorrow. Reach out if you have any questions, but otherwise, thank you guys so much for joining again, and we'll see you next time.
Have a good night. Bye.
All right.